Hey guys, what's up? It's going Robin here. Welcome again, once again, to another video on the channel. And in today's video, I'm going to be doing a full thorough stock portfolio update. I'm going to be showing you guys my entire stock portfolios. And because we are getting towards the end of November, I kind of like to do these videos about once a month. And I haven't actually done one for a while. So in today's video, I'm going to be going through every single stock that I own. I'll show you guys how many shares I have, and I'll go through all my portfolios so you guys can see how my portfolio has been doing since I've started them over the past couple years. So like usual, if you guys enjoy this video, please be sure to give the video a big thumbs up, and remember to subscribe to the channel if you guys want more Canadian-based investing content. So the format of this video is going to be pretty simple. We're going to start off with going over my Canadian growth-based portfolio, which is in Wealthsimple Invest. This is a robo-advisor account that I started way back in 2019, and it is a very diversified portfolio that's all over the place. So we'll check out that portfolio first, which is my biggest portfolio. And then we'll jump into my Wealthsimple trade account, which covers my Canadian dividend-based stocks. And then we'll finish up the video talking about my Canadian REITs, and I'll finish up the video talking about some of the goals and some of the plans I have going into the future in regards to what I want to do with my stocks. So if you guys enjoyed this video, please give it a big thumbs up. Remember to subscribe, and let's get going. Alright guys, so the first portfolio we're going to be talking about in today's video is going to be my oldest portfolio, and this is actually where I have most of my money on, and this is Wealthsimple Invest. And I started this portfolio way back in March 2019. That's when I first started actually investing and using Wealthsimple, and you guys can see here that like around March 2019 I started to put in a good chunk of my money, and that's when I really got serious with investing. So even though on this channel the main thing on this channel is I focus on is my dividend based portfolio and how I've grown that since the start of this year, this is the first portfolio I ever made, and this actually holds like the bulk of my money in my TFSA, the first one I made with Wealthsimple Invest. So I don't talk about this portfolio that much because it's not really that interesting, because it is with a robo advisor and they pretty much do everything for me. But I do like to touch upon it because it's interesting to compare the two and see how like a portfolio that was started a year before, how it's kind of going in comparison to one that I started this year, especially with the way the markets have been this year. So the portfolio has a total of $53,415 in it right now, and it's up $5,753, which is pretty good, and it's got some pretty big jumps over the past little while. I'd say the past month or two it's been pretty decent gains over the past little while. We can check here on the tabs. I'll just zoom out a little bit. We can see that over the past month we had a nice little increase here. The past 3 months, once again, nice big jump here. Starting in October, we got a nice little jump, and it's pretty much been like a slow rise ever since October. Since then, this is pretty much like the entire stock market just kind of starting to rally. We've seen the U.S. stocks kind of jump up throughout the earlier part of the year, and then towards the end, we kind of seen everything catch up. And that's kind of as I think most of us kind of predicted. If we go over to returns tab here on Wealthsimple Invest, we can see the actual percentages. So we'll change return type to a simple percentage, and we can see that the portfolio is up 6.6% all time. And I guess it's been invested for about almost 2 years now. It's about one year and maybe 3 quarters, so 1.3 years, I guess in March of 2021 it'll be a full 2 years. So it's not like completely 2 years yet, but it's interesting to see where this portfolio is at. But keep in mind, like, this portfolio went down quite a bit when the market went down, especially since it's like a very diversified portfolio. So if you guys are using Wealthsimple Invest, we are using the high growth portfolio, which has a 90% equity ratio and a 10% income. Once again, this is a risk level 10, and we'll check out the holdings here, and I'll give you guys a quick little overview of the ETFs. And then once we go to the ETFs, we'll jump over to the Wealthsimple trade account, and I'll show you guys my dividend stocks and my REIT stocks, and show you guys how those stocks are doing, since it's a little bit more interesting. And it actually goes in, I actually have like some individual stocks and whatnot other than just ETFs in those portfolios. So this is a portfolio that's mostly US based, and it's really nice because US stocks have done the best, but Wealthsimple is really into like diversifying across all kinds of different areas, as you guys will see here. The first ETF that they invest into is the most heavily weighted ETF, which is VTI. It's the Vanguard Total Stock Market ETF, a really solid ETF. I almost wish they would put a little bit more VTI in their portfolios, but 23% is pretty decent, almost 25%, I guess. Market value of $12,000 here, 50 shares, up 20%. So performance of VTI in this portfolio is up 20%, which is pretty crazy. US stocks, even though everything that's happened this year, US stocks still continue to do well, oddly enough. It's been a weird year, that's for sure. Next ETF here is XEF, which is an international equities, and this one went up quite a bit over the past month or so. I've seen a nice steady increase in this one, which has been nice to see, and it's $11,000, so quite a bit in XEF as well. And we have 365 shares, which are up 9.2%, which actually isn't too bad. Once again, all things considered, with everything that's happened this year, going up 10% is pretty decent. The next one we have is probably the lowest performing one, other than our global equities, is emerging markets. Now, emerging markets are ones that coming out of like Asia and stuff like that. A lot of like stocks from Japan and China and all those places and whatnot. We have $9,000 here, 114 shares. We are currently up 3%. Now this one got hit pretty hard. It was down like I think -8 to 10% or even more. I think it was more than that earlier this year. So it got hit pretty hard. So it's kind of had a slow recovery. I expect it to have a good year next year. And maybe if it has a good year next year, I might actually move some of this money into my Wealthsimple trade account. I'm just kind of waiting for some of these ETFs to recover because I think some of them are going to have a good year over the next couple of years to kind of make that recovery. But we'll have to wait and see. Next up we have is XIC, which is a Canadian equities ETF. It's kind of like a mix of growth and dividend stocks. We have $6,000 in here, 220 shares, up 8%. Once again, this has kind of been a slow, steady rise throughout the year. Nice to see Canadian stocks doing half decent though, amongst things like obviously not as good as the US stocks as of right now. Keep in mind this will change, but I do believe that these, the Canadian stocks should do a little bit better. And it's interesting to compare like XIC to like VDY, for example, which I think is actually performing a little bit better. But this is a mixture of growth stocks and dividend stocks. So not too bad though overall. Next up we have is ACWV. This is a global equities. This one has got hit the most. And I think this is just a little bit of everything. Like I think this has a lot of Europe-based stocks, a lot of stocks like just everywhere. And as you guys can see, like the overall broader stock market is down, but like Canadian and I think US stocks are up quite a bit. So it just depends on where you're invested, right? But we have $5,600 in here, and we're up 1% with that. And then at the bottom here, we have a US equities, so it's Canadian hedged. And I don't know, I'm not too sure why this is in the portfolio, but it's performing well. I'm not going to complain. But it's basically like a Canadian hedged version of the VTI. And this is $3,194, up 23%. Then at the bottom here, we have some bonds. And oddly enough, earlier this year, Wealthsimple changed one of the bonds. I think it was the Q-tip bond. ETF, they changed it to this gold GLDM ETF, which is kind of interesting. And gold was up quite a bit earlier this year, but it looks like it's actually kind of leveling off a little bit. So that was an interesting decision by them. But yeah, they did that. And then we have ZFL, which is another bond which has performed okay. Bonds are still doing decent for now, but we'll have to wait and see in the future. And once again, the bonds are only like 10% of the portfolio, so it's only about 7%, and then gold is the rest, the other 3% to make up 10%. So it's really not that much of the portfolio, but overall I'm pretty happy with the portfolio. There's been a nice recovery, and I expect this portfolio to kind of jump up over the next year or so. I think going into next year we should see this portfolio jump up quite a bit. But we'll just have to wait and see. So I wanted to do a quick little update on that, because I know you guys have asked me about this, and this is one I've talked about a lot, and this is like where the bulk of my money is. So let me know what you guys think in the comments, and there is a link to Wealthsimple Invest if you guys want to set up your own account in the description of this video as well. So let's jump over to Wealthsimple Trade, and let's see how my dividend stocks are doing. Alright, so for this video, guys, I'm going to be using the beta version of Wealthsimple Trade. It's currently out for some people. Some people have it, some people don't. So I want you guys to know that if you guys do set up a Wealthsimple Trade account, the beta version of the desktop is not quite out yet. So I don't want anybody to think that it is. It's still in beta. So they're kind of rolling out to a few people like slowly over time, so just kind of understand that. But we're going to be using the beta version in this video, and we have a total of $12,000, $452, and this is predominantly a Canadian-based dividend portfolio for the most part. We have Canadian dividends, and then we have Canadian REITs. So we're going to go over the Canadian dividend stocks first, and then we're going to go over the REITs, and I'm going to talk about some plans on how I'm going to probably put the two accounts together before the end of the year, since we're nearing the end of the year, and I want to do this before the end of the year because I want to put all of my TFSA account, and I do have some free contribution room. So the basic plan is to take my REITs, stick them into my TFSA before the end of the year, then by the time 2021 comes around, that contribution will reset, and then I can kind of maximize my contribution, hopefully fill up my TFSA going towards 2021, because the new limit I think is going to be around $75,000, so I should have enough to maybe fill it up by next year, hopefully. That's kind of like the number one goal for me for a long time has been that, and it's been a long goal, but we're almost there. It's been a long one. So we'll jump in the dividend stocks first, and we'll just take a quick little peek here so you guys can see. In the dividend portfolio, we have $7,497. We are currently up by day, down -1%. So the stock market kind of opened at a negative today, but I expect it will probably level off or kind of rise a little bit. As you guys can see, it already has over the past week. this portfolio is up 3%, so we've seen a nice little increase over the past week. Now, over the past month, we're up 13%. So our Canadian portfolio has done quite well in the past month. Like I mentioned earlier, like the overall stock market's up quite a bit. And it's interesting to see, as we go through this, how this portfolio has kind of performed compared to my other portfolio that I had before the stock market crash. And you can see the big difference in like how the percentages change. Like, right, like this portfolio is up 8%, while my other portfolio was up like, what was it, 6%? So it's a big difference, but at the end of the day, the more money you have invested, the more money you make, right? Like this portfolio might be up 8%, but it's only up $600, which is a lot different than, what was it, like this $5,000 to $6,000 the other account was up. So it's interesting to compare the two, right? At the end of the day, I'm a firm believer that the more money you have, the more money you will make, and the quicker you can invest it, the quicker it'll grow. So I think that holds true here, but it is interesting to see the differences here. So going through the stocks here, we'll talk about these, try to get through this pretty quickly so the video is not super long. But we'll cover the Canadian stocks first here. So the first stock we have here is Algonquin Power and Utilities. And I bought this recently, I'd say over the past month or so. And, they've been doing okay. This is a long-term growth stock. If we look at Algonquin Power Utilities over the past 5 years, they're up 97.58%. It's a growing company. It's doing quite well. It actually had a good recovery from the pandemic, so we probably won't make any money in the short term from it. But over the long term, this is a stock that I'm going to be buying, and they are growing, constantly growing their dividends and whatnot. And I think this is a nice long-term company. I currently only own about 6 shares. I've been slowly buying into it, and as you guys can see, my all-time performance is down negative 4.68%. But that's okay because I do believe over time this stock will grow. And the next stock we're going to talk about is Enbridge, and Enbridge has kind of had interesting lasted a while, and Enbridge have actually seen a pretty good recovery. If we go to Enbridge, we have 3 shares, and over the past 5 years, Enbridge is currently down about 12.57%. So it's in an interesting spot. I know a lot of people are buying it because they're kind of predicting that going into the future, it's going to grow, and it just might. I have it in a lot of ETFs on these portfolios, so I'm not buying too many shares of Enbridge. In fact, I'm probably not going to buy anymore because it is in one of my ETFs called VDY. I have a lot of, it's a heavy weighted stock in that ETF, so I don't think there's really a point to buy any more shares. But as you guys can see, we have 3 shares, and it is currently up, I guess it's down negative 0.18. So we've seen a little recovery over the past little while from Enbridge, up 12% in the past month. So if anybody's been investing into Enbridge, you're probably doing okay. So, I think Enbridge, once again, is probably going to be one of those stocks that's just going to do well forever. So I think it's definitely probably a good stock to invest into. Next up we have is Fortis, and Fortis is a Canadian utilities-based company. Once again, they're kind of like a more stable version of Enbridge. Once again, long-term company to hold. Over the past year, they're up 5 years, they're up 41%. So this is another long-term growth stock that I'm buying. And we bought 4 shares of it, $209, and it's currently down about 2.59%. So once again, this is kind of expected, especially since they've had a good recovery. So not many big gains, short term, but long term, I think they will grow, and that's why I've kind of been investing into them. Next up we have is H&R REIT. Now I bought H&R REIT last week in my stocks to buy video. By the way, you guys, if you guys don't follow those videos, check them out. The reason why this REIT is in this portfolio is because I'm slowly transitioning my REITs into my TFSA. So instead of buying more in my personal account, I just bought it in my TFSA, and probably over the next couple days, I'll probably do a video where I'm going to sell my REITs and then stick all the money, transfer into my TFSA, and then just buy a few select REITs that I think are going to grow into the future. And H&R REIT is definitely one of them. So we'll talk about this stock when you go over to the personal account, because I think that'll better reflect how that has been doing for us. Next up we have is Manulife, and Manulife is an amazing stock. I think they have tons of potential. I've talked about them already. It's currently down about 15% year by year, so tons of growth going towards the end of the year. And once again, if you go over the past 5 years, we can see that they've went down quite a bit, but I still think they'll do a good recovery, and at some point in time we should see some nice gains. In fact, we've already had some pretty good gains. We have 24 shares of Manulife, $529 in value. We are up 10.43% already, and really nice dividend yield right now. I think it's sitting like at a 4 or 5% dividend yield, so that's really nice. And like I said, we still have like about another 15% to go. So go over the next couple months to maybe a year or two, I'm definitely going to be buying Manulife, and I think they are like a really good undervalued Canadian company to buy right now for sure. Next up we have is one of the best performing stocks in my Canadian dividend portfolio, and that's TransAlta Renewables. This is another utility-based company based on renewable energy, obviously, and they've done quite well. Over the past 5 years, they're up 75%, so once again, this is a growth stock. But keep in mind that this stock is relatively new. It's not super old. It's almost like a newer version of Enbridge and Fortis, but they've done quite well. They've done pretty good in the recovery from the pandemic, up 18% this year. And I'm going to be slowly investing into them because I do think they have long-term growth. And we have 17 shares, total value of $304, and we have 21%. So that's nice to see. And they do have a nice monthly dividend. So that's pretty good for them as well. I think going in the future, they should be a nice growth stock. And although we might not see any major gains over the next little while, it should be a nice slow and steady increase. So I think that's a pretty good stock to buy. Next up, we have a Savaria Corp. Savaria Corp I bought way back in the pandemic, and they're like a accessibility healthcare based stock. I don't know how they're going to do. They did quite well at the start of the year, but if we go up year over year, as you guys can see, they've kind of dipped down a little bit. A lot of the health based companies that like went up really well when the pandemic happened are kind of starting to dip down a bit. So I think maybe the markets are starting to kind of stabilize. I think maybe they shut up and were like a little bit overvalued for a little bit of time there as everybody was, going a little bit crazy. But yeah, as you guys can see, they kind of went down a little bit. So I don't know if I'm going to be buying Savaria Corp going into the future. If we go over the past 5 years, they are up quite a bit. So that is a good sign that maybe they are a pretty good growth-based company, growing 153% in the past 5 years. But I'm not going to go super crazy. They do have a monthly dividend, and it is a growing dividend, so that does have potential in the future. So I think I'm going to keep them on my watch list, and we'll just keep an eye on them. We might buy a couple shares here and there, but I don't think I'm going to go too crazy. But there is potential for sure with Savaria Corp, and I think they could be a good buy. Next up we have here is a long-term classic Shaw Communications. This is an interesting stock because, they've had an interesting while. Over the past 5 years, they are down actually 17.67%. So they've had quite a bit of a decrease over the past little while, and I bought them originally because I had a nice dividend yield and they had a monthly dividend, which is very attractive. But, looking at their past performance, this doesn't look like a very good growth stock. Now, investing right now while the stock is down quite a bit might serve to be grow in the next couple of years, which would be a good buy. But in reality, the growth of the company isn't really kind of getting me excited. Like going down 17% in the past 5 years, it doesn't really show me signs that they're doing well. And as you guys can see, we're currently down -5% in our portfolio all time. So this is something I'm probably, it is in some of my ETFs that I hold, so I'm probably not going to be buying any more individual shares. But I don't know. Like I think some other companies like TELUS and maybe even Rogers are probably better telecommunication stocks to buy right now. But hey, you know what, Shaw, they have had a history of doing well, and if they are going down, they might recover. But I'm probably not going to be buying any new shares in the future because I think, like companies like TELUS that I have here are just going to be doing better. Like TELUS, if we compare TELUS to Shaw, over the past 5 years, TELUS is up 20%, with a steady growth and steady growing dividend. So, I think there's more potential with these companies, especially since they got a better handle on things like the new networks coming out and whatnot. So I think these might be better stocks to buy right now. We are currently up 6% with TELUS, and we just kind of started buying into TELUS, so we haven't had it for super long. But I think that might be a better buy. It's kind of hard to say. Next up we have is my favorite bank stock, TD. And TD is a stock that's been absolutely doing crazy. Over the past 5 years, they're up 30%, and they recovered quite a bit over the past pandemic. You can see they had a nice little jump here with all the Canadian stocks going up in the past month. TD kind of rose up with them. We have 14 shares of TD, total value of $983. We're up 10% with TD, and I probably will be buying TD because they are a solid stock that keeps growing. They have amazing dividend growth, and we got to buy a lot of those cheap shares with a good dividend yield. So I'm definitely going to be buying more of TD as time goes on. It's probably the only Canadian bank stock I hold. I sold all my other Canadian bank stocks because I'm trying to kind of like focus more on one, and then I'll just keep buying VDY, which kind of has everything in it. Which leads me to my next point. The next stock we have is VDY, which is an ETF, and it kind of covers the entire market. We have 71 shares of VTY, $2,000, and we are up 8.53%. So this is an indicator of the entire Canadian market doing quite well. And this also has a nice monthly dividend yield. And VDY is up 16% in the past 5 years. Once again, it's kind of doesn't seem that much because of the pandemic pushing it down. But it is a good, nice stock that's done a nice stock-based ETF that's done well, and we're up $179, which is 8.33%, which is pretty sweet. And I'm going to be VDY is the main ETF I'm buying inside this portfolio, so we can keep getting that dividend growth and putting that back inside the portfolio. Going towards the bottom here, we have some ETFs that I no longer buy. I'm just kind of holding them waiting for them to grow. So we have VYM, which is US based ETF. We'll be adding a couple shares here and there as they grow, but I do have a lot of US stocks in my growth portfolio, as you guys have seen. So I'm going to be adding a couple, but I'm not going to go super crazy. Next up, we have is VYM. I bought this way back in the day. I'm not going to be buying any more shares. Same with XHD. Bought it back in the day. Just kind of going to hold it and let it grow over time. Same with XRE and same with ZWC. Some of these are great ETFs. I just don't think I need them all in my portfolio. And because they are like, some of them are still not really doing that well, I'm just going to hold them till they recover, and maybe if they jump up, I'll sell them. We'll just kind of have to wait and see. But that's a basic overview of my dividend based portfolio. Hope you guys enjoyed it. Let me know what you guys think. We're going to jump over to the REIT portfolio and we'll talk about my Canadian REITs. Alright guys, so we're almost done the video here. I know it's getting a little bit long, so we'll kind of go through this pretty quickly if we can. The next account we have is my personal account, which is where my REITs are in. And as you guys can see, this portfolio has done absolutely crazy, up 20% all time, which is a total of $800 from such a small portfolio. It's pretty sweet. And as you guys can see, like tons of growth over the past couple months. Over the past 3 months, this is pretty much where most of this growth came from. Absolutely crazy with Canadian REITs, and a lot of this is just, there's some stocks that are pushing up, and it probably would be a little bit more because there are some that are down. But if you look at the overall portfolio, pretty much everything is up right now. And like I mentioned earlier, the plan going into the future is going to be to sell these stocks and move them into my TFSA. I would have done this sooner, but I didn't expect them to grow so much. Like, I think it caught everybody, including myself, off guard, how much Canadian real estate just jumped up. So again, I want to kind of emphasize, if you guys have room in your TFSA, just stick stocks in there, just fill it up, because you never know that growth, if you can get it tax free, it's going to benefit you a lot. Now, obviously, if I sell all these shares and I move it over, I'll have to pay tax on the total $800, but like, it's really not that much money. Like, what will you pay with that? Like maybe $100-$200 or something like that. It's not a big deal. But at the end of the day, like, I want to get those into the TFSA so they can keep growing, because a lot of these stocks I bought, they're still really, really undervalued. They still bought them at cheap prices, and I got nice, good dividend yields. So I want to keep getting that over the next couple of years. First stock that was done absolutely crazy for me is BPY, Brookfield Property Partners. We have 23 shares, up 30%, absolutely crazy. Then we have Dream Industrial. I bought a couple shares of this, and once again, they're doing pretty good, up 13.22%. We have 5 shares, not that much. I probably will be buying more of this, but I think some other companies right now might be more better buys. And I've talked about this in my previous video, and I think the 2 companies that are definitely worth buying right now are going to be H&R REIT and RioCan. Like, these are the 2 big ones for me, and the reason why is because they're still down quite a bit. H&R REIT, we have, year by year is still down 34%, so there's tons of growth. And as you guys can see, as everything's opening up, their earnings are going back up. They're going to get that stock recovery. So as you guys can see here, we are currently at 42% already, and we still have like 30% to go. So I think H&R REIT is going to be a good buy. RioCan is a good long-term consistent buy. They have a nice good dividend yield, and they are still down 34%, and we are up 16% already. And remember, we locked in that nice dividend yield. So this 8.57% is getting like a dividend yield of like 8 to 10%. Like, it's absolutely crazy. So that's kind of locked in as long as they don't reduce their dividend, which they shouldn't. That's going to really add up over time, right? Like think about it year by year. Like, even if, RioCan just gets like a 10% recovery next year and you get that dividend yield, that's an 18% gain right there. So, it's going to add up a lot in the future. So that's why I kind of want to get these stocks into a TFSA. Next up we have is CI First Asset Canadian REIT ETF. We bought this a long time ago. I'm not really buying any more shares. As you guys can see, we have a bunch of different ETFs, and as I move this portfolio into the TFSA account, I'm probably just going to focus on one ETF, like 1 or 2. I might buy some shares of VRE, and I don't know, I might buy some shares of XRE. We'll have to wait and see. I'm going to have to compare the 2 because I know they're kind of similar, but I might just pick one ETF and just kind of go ham on that, and then kind of maybe like clean up some of the portfolio while I'm at it, since a lot of these stocks are up quite a bit. That's kind of the plan going into the future. But as you guys can see, XRE, even our main ETF, is up 13%. Still doing quite well with still lots of growth. It's still down 15%, so still tons of gains. Same with XRE. We're up 6.67%. Still down 17%. So lots of opportunity going in the future for Canadian REITs. So that's the REIT portfolio, guys. Once again, if you guys have any questions on that, let me know. And that's pretty much it for the portfolio updates. Let me know what you guys think in the comments below. And if you guys enjoyed the video, please sure to give it a big thumbs up and remember to subscribe. And what I will do, guys, before I end this video is I'll put a link to an end screen. I'll link to my Canadian stocks I'm buying videos, check those videos out, because inside those videos, I do them every couple days. I show you guys the stocks I'm buying, and I give you guys little updates on the portfolio. So check that out if you guys want, and be sure to subscribe if you guys want to see like all the updates I do on inside this portfolio as it grows. So thanks for joining me today, guys. I know it was a pretty long video, and I apologize for that, but I hope you guys enjoyed it. So take care, have yourself a good day, and I'll see you guys later.